Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Our clients tend to be fairly educated, more highly educated than the average individual. In fact, a lot of our clients are even executives that worked in the arena of finance, and they understand the complexity of the markets. They appreciate the in-depth expertise that we bring. And what's interesting is that the more educated somebody is, the more usually they understand about investing and recognize the value of professional management.
Yep.
Yeah, unfortunately, it's not always like the case, Steve, right? I mean,
No, it's
but
not, because a lot of people may view it as a cost rather than as a
right.
benefit. And so
Well,
I
I
think
think
really,
it's the less informed people that, gee, they
right,
just don't understand. They think they've been told either, number one, the market is
right.
very efficient and therefore they should just buy an index and be invested in it,
Yep.
or they've been told that they can actually beat the market and they should try to time it and so forth. And either one, of course, is not helpful, right?
No, timing, it doesn't work. I mean, it's if you were able to successfully time it, odds are it was more luck than anything else, quite honestly. In fact, I know of an advisor, I won't mention her name, who decided to try to time the market in April and pulled a lot of his clients' money out of the market when it dipped so much in
Oh
April
boy.
because of the panic over tariffs, which was unfounded.
Yeah.
And unfortunately, he missed the recovery, and it recovered as usual, recovered swiftly, and to try to catch that recovery it's very hard. Plus, if you're doing this in a taxable account, what are you doing? You're potentially just creating a tax event for your clients with
We
no
see it all the
upside for that.
time. Yep, yep.
So,
So the role of a professional manager, our role is really to cut through all that noise and to not advise people that way. Unfortunately, we know that the quality of financial advisors out there is extremely diverse. But those people that are educated in finance, have studied it, have studied investing in economics, and
hmm
who have been working in it for many years, know that it's our job to use the science behind investing. There's a whole body of work that's out there, and
yep.
to help people to not react emotionally, not to fall for the myths, to use the
hmm
research and the experience and the education to make better decisions.
And being investment geeks, we love that stuff.
That's right. Um, so really the benefits, we summarize them on this page, and we're going to go through all of these points here. But it really starts out with having a whole comprehensive approach to professional investment management. And when somebody comes and they say, I want to here's $1 million, go invest it. That we're not
hmm
doing that. We're never doing that. Don't come to us with a pile of money and just drop it on our doorstep and say,
Nope.
start investing, because that is not, we think that is just right off the bat the wrong thing to do. We think that it's
Yeah.
very, very, it starts with that whole comprehensive approach and the custom strategy that we've selected for you, for your life, not for our lives, but for your life.
Yes, and plus, you're setting yourself up for potential failure if we did it that way. If the morning market does decline 20%, and it will, and if you're in the wrong model and the model doesn't really match your need for money from your portfolio, you're going to want to sell in that down market. And if potential, you're going to want to move to a more conservative model. And when the market's down 20%, that's the worst time to do that, because you're not going to take part in the recovery as fully as you would be if you stayed in the same model. So that's why it's so important that we really adopt a strategy that really matches your goals and objectives, your risk tolerance, and also your stomach for market declines. I mean, as we're going to talk about here, we can reduce them dramatically, the impact on a portfolio, but we can never totally eliminate it. So,
Right. And so we have a whole slide of all the types of things we try to consider. But it starts with our overall process. And so our process involves the whole, first of all, client discovery, getting to know you. The
hmm
second piece, understanding your overall goals and your situations and what kind of choices you have, to
yep,
creating an investment strategy for you, to then looking at your overall risk exposure, what else do you have going on in your life? And
Yep.
then also understanding your estate plan, all of that before we even really start making any decisions on investing.
And I
I
want to
will say,
mention the intellectual capital that went behind this approach. I've been doing financial planning for 30 years, and Laura close to that as well. So a lot of intellectual capital's gone into this over the years. It's a very well-defined and well-developed process as well.
that's right. And so we started brainstorming a little bit in terms of what are some of the data points through so that process in
Mm.
itself is very valuable.
Laura, are you going to go through each one by one?
No, 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 no.
I'm
We
joking.
want to say that that process is very valuable and you get a
Yep.
great comprehensive plan for it. But more than that, even if you're working with us in terms of having us be your investment manager, we're gaining knowledge and understanding of what are unique aspects of you and your life. And so
Right.
the types of things that we're actually pulling out of all of the process are things having to do with what are your cash liquidity needs? What are your tax considerations?
Right.
What about your risk profile needs, capacity, tolerance? What about your
Also, where can you get
objectives?
money in a smart fashion if there's some sort of emergency that you need money quickly? That's
Right.
also very important, especially in a bad market.
Right. So all that comes out of this. How should we structure your accounts? What about you? What are you expecting you're investing this money and saving it so carefully? What are your expectations for this money when you're no longer here? And various other considerations in terms of even like who else are you working with? Are you a business
Hmm.
owner? What else do you have going in your life that might play into this? So this financial planning process produces a lot of information, and you can talk to any one of these bullet points, and it will change what we're doing for you versus what we're doing for the next person.
Very customized.
And so that whole strategy, that whole financial plan is what feeds into the investment plan and your overall comprehensive investment policy statement, which is the roadmap that we use to make decisions around investing. And so, and this term comes from the world of endowments and,
Right.
you know,
Trusts.
right. And where they develop these very specific, these are the rules of the game. This is what we're going to invest in, what we're not going to invest in, when, why, how. And then we start making decisions. So, Steve, if you can click on it, it shows now this is now how we're making choices for you. But then we're
Right.
having ongoing meetings with you, hopefully, so that we know how you're feeling about this and how, with there's additional information we need to go back to the financial plan with. And we're also doing that additional external monitoring of the economy and the markets and what else we should be consider as we formulate this plan.
Right. I want to mention a couple things. First of all, even though we do that financial plan up front, we don't view that as a one-time exercise. It's something we do on a continuing
The
basis because
process.
things change. Tax laws change. We just saw that happen again. Other opportunities may arise in terms of how we do things for you. So it's an ongoing process. We typically revise everybody's plan on a regular basis,
Right.
and that's an important part. And it also helps us decide rather whether you should be in a different model, whether you're in the correct model. Does the model that we have you in match your long-term goals for investment return so you can meet your objectives in retirement or for whatever reason?
Yeah.
So it's really an
Situations change,
ongoing
right?
process.
Yeah, it's
Yep.
situations change a lot, especially for the client as well. I
Yep.
mean, one specific thing that I can think of that really we try to look at all the time, every year, is people's tax situation. How is your
Yes.
marginal bracket changed? Because that will affect how we invest. Um,
I'm actually speaking on that topic at an event tonight.
yeah,
So
yeah, great. So the custom strategy really important. But
yes.
after that, risk management, and that to us is just really, really the name of the game. There are people with
Right.
the ability, for whatever reason, to take on a lot of risk, and there are people with the not, yeah, they can't take on as much risk for whatever reason. Um, there are ways of managing the level of risk that you can take. And we've done some videos on that, and we'll continue to do that because it's really the core of investment management is risk management.
It
Um,
is, and as they say, the only free lunch in investing is diversification, quite honestly.
right,
It's the one thing you can do to
right.
help return. And diversifying properly eliminates a lot of risk. Not all of it ever, but a lot of it. And we're going to show you why that's so important.
Yeah, it's this whole idea of having, if you take two different assets, up until prior to this theory being introduced, which was introduced 70 years ago initially,
Right,
people just looked at, what is this one, we have this one investment. What is the profile of this one investment? What is its risk? What is its return? And the theory was introduced, and they said, well, no, this investment operates very differently when it's combined with this investment. And so we need to look at the whole recipe of including these two investments together. And
right.
by including them, hopefully these investments are unique in their own risk profile and how they operate. You're going to get a smoother out return.
And I think before that 70 years ago, they didn't even really look at risk mathematically, and that was one of the major I would say advances in that area, looking at it mathematically. But by the way, mathematics don't fully cover all of the risks, but
Right.
covers a
Yeah,
lot of it.
this theory is by far one of the top theories in the world of economics and finance. And the fact that
Yep.
I don't hear a lot of advisors, and I think that's the difference between having a true finance professional versus having a salesperson or a broker,
Right.
is they haven't been taught. They don't even know this exists.
And I don't want to knock on the
Click
CFP program.
click the thing one more time, Steve.
Sure, we're both CFPs,
That's,
but we've gone way past the CFP designation. And CFP designation is rather weak, the investment section. They really don't teach the certificates how to manage portfolios per se in that program. It's
it
been a pet peeve of
depends.
mine.
My
Yeah.
students at USF were taught.
I'm sure you did, but you're an exceptional teacher. Yep.
Um, and so the little exercise that follows here takes just the ideas behind this. If it takes two investments, investment A and investment B, and it puts it into um, a, a, a return cycle. If you could click again. So we have investment A, investment B, and if you said you're putting these two investments in. For just without knowing years one and two's performance and just said the
Right.
average return, most people would say investment A would be their first choice. Um, but when you look at the volatility of how investment A went up 50% and then down 26%, you might question that. Um,
Right.
and you'd be right to question it because the data shows that investment B was actually a better performer, even with that lower average return. And that has to do with things that we've talked about in the past, like geometric mean and volatility
Mhm.
drag. But combining them together, that's what gave us the best return. Overall, AB, regardless of what the
Right.
average says, which we know the average is misleading, you actually wind up with more money afterwards.
Right. And by the way, the more volatile a portfolio or an investment is, the greater the difference between the average rate of return and the geometric. If there was zero volatility, those numbers would be equal. But if you have any volatility, those numbers are different. And volatility always drags down the average into the geometric return. It's always lower if you have volatility, in other words.
And so things that Steve and I have talked about in the past, geometric mean, volatility drag, improving the
Right.
Sharpe ratio, which is the better return for every given level of risk. All those
Right.
concepts kind of fold into the underlying reason why this works the way it works. And this slide I actually stole off of I think Morningstar did it or whatever. And
Hmm.
it's really kind of very, very
Good
interesting.
slide.
Yeah, it just shows over the past 5 years. It starts out in 2007, and it goes to 2023, and it shows on the
Right.
left-hand side just the S&P, what the S&P did. So it went down, it went up, and so forth. And it said, what if we cut off 75% of the upside and 75% of the downside? How would you have done with a smoother portfolio? well, you would have had a little bit more money. You also probably would have not sold at the wrong times, all that kind of thing. And so that's what we're trying to do is give you more
Yeah,
control, especially imagine when you're taking money out of your portfolio, taking money out during those declines, very painful.
right. It, it also reduces the impact of we're all human. We all have our behavioral issues where we get very nervous when we see the market decline. You don't see your portfolio declining as much. You're less likely to make some sort of rash move. And that's really important too. By the way, that's one of our benefits that we add. We are very unemotional in this. We don't make these moves based on where the market is, and we always try to prevent you from doing it. We have to follow your directions. You want us to absolutely get out, we will, but we always try to help you and try to counsel you not to make some sort of rash decision during a
That's
market
hard,
decline.
Steve. I mean, even yesterday I was asked by a client, well, what do you think's going what's going to happen over the next month? And yeah,
We don't know.
yeah.
And while we like to monitor economics, economic predictions, so few of them are right. And I always like to say that there's two aspects to it. There's the mathematical models they create for economics, but there's also external events which are not models. Like, for example, who
There's,
modeled COVID?
there's a
Nobody did.
third, and that's the sentiment, where people
Yes.
just make irrational, like the market just
Yep.
behaves completely irrationally. I mean, for a long period of time, we've seen chunks, even years of irrational market behavior. Um,
Yep.
so,
We know it's built into pricing there. So,
right.
we try to avoid it by being well diversified as much as possible.
So that risk management is really important. And the idea that the industry has adopted is this concept of a 60-40 portfolio. A lot of people have heard it. What it is,
Yep.
60% large cap stock and 40% US bonds. And we know that that has not always worked to our favor, right? And
No.
reason why is over the past 100 years, US stocks and US bonds are not always uncorrelated. There have been times where it's been very correlated and other times when it
Right.
hasn't been correlated. We had a period in the 80s where it was very correlated. Then it came down. And so this chart on the right-hand side of this shows how it's the correlation over time from since 1980 through 2010, where it was more and more less correlated. And so that was good. You got an asset class that was zigging while an asset class was zagging. Everybody was somewhat okay with that. And so this portfolio didn't work that badly, although you could have done better if you were more diversified.
Yep.
We'll
This is
talk about
also a knock against a simple mathematical construct called correlation. They're much more complex constructs that actually take into account the fact that correlations are not stable and they do change.
it.
And
Right,
we use that, by the way. I'm not
right.
even going to mention the name
But
of it.
but looking at the static correlation of yeah of what we're seeing here, you can still see the concept that
Yep.
starting in 2010, the stocks and bonds started moving in the same direction more and more over time to the point where in 2022, when we had both stocks and bonds go down by 16, 18, 20%, yeah, they all went down together. And everyone said, oh my, we never thought that could happen again. Well, look at the relationship of stocks and bonds. It is very possible that that can happen. So the 60-40 model is not dead per se. It's never been enough. And that's what
Right.
we feel that it's out. The idea is way outdated, that people really haven't, they don't understand what they're doing if they think that that's protecting themselves enough. It's just one possible diversifier away from the US market. And
And funny thing, I've
governments
spoken to
have
a lot of
been,
advisors that that's exactly what they do. They don't use any of
they
the
don't understand. They don't
the
understand.
current academic research. They don't use any of the advanced mathematics, none of it, which is kind of scary.
Right. But the experts in our field do understand. And the
Yeah.
experts, whether you're working for a family office or you're working for an endowment,
Right.
you're working with more sophisticated people. And unfortunately, a lot of people, if they don't have $10 million, they're not working with a more sophisticated advisor. They don't have the ability to get this type of thing. Fortunately, we at the Atlas team understand this, and we've created these portfolios using a lot of other asset classes to diversify.
Yes. By the way, the 60/40 a lot of times excludes international, by the way, too. And that's been one of the
Oh,
better
the
performing asset
purest,
classes for the
the
year.
purest is just large cap, period. Large
Right.
cap. Um,
Yep.
and that we see that all the time. I mean, very
Yep.
rarely do I see international in people's portfolios these days
Nope.
when they move to us. And
By the way, another one that's beaten the S&P this year, convertible bonds. I mean, too. Up about 11% right now for the year.
well, international is doing fabulous also.
Oh, it's up about 20, over 20, I think, right
So,
now.
so we have this portfolio, and what we want to do is we want to kind of go through this these different asset classes and not necessarily talk too much about the specifics of the choices, but talk a little bit about why the types of choices, more about the type
Right.
than the specifics, might be a little unique. So if we
Yes.
start with U.S. large cap, which is what everybody thinks about. We've all heard about the research, and Steve and I have studied it and read it, that in the large cap arena, um, there are analysts all over the world who are studying those large cap companies. And so
Right.
Coca-Cola has thousands of people that are professionally in charge of Coca-Cola, and they've analyzed all the data. And when we start looking at the opportunity to outguess what the market is saying, it's very, very hard. And so the data has told us that the large cap arena tends to be very efficient,
It
although
is.
the value area. So without getting into too much detail of this particular metric, um, and Steve, this came from you actually. You pulled this from Morningstar. I cut out the other
Morningstar.
things to just say, okay, in a
Yeah.
20-year period, how many advisors within these different asset classes actually outperform the benchmark? And we can
Right.
see that when you looked at large cap, particularly growth, um, not if you look at more value oriented, but you
Hmm.
very few advisors ever actually outperform 2%, 2.8% of those advisors actually were able to beat the benchmark.
And that's amazing because part of the problems they have a lot of the active managers have a higher expense threshold that they have to exceed to beat the market. And if they have a 1% management fee, that means they have to beat the market by 1% just to match it right there alone. So it's hard for them.
But if
And
you
that's
look at
why
this,
having a low cost index fund with 20 basis points or depending on the type of index fund or 5 basis points of expenses means you're going to get very close to the market return.
right, and for large cap, for large
For
cap,
large,
that's what we do.
exactly.
But if you
Yep.
look at the slide here, you can see that mid cap and small cap, as well
Yep.
as international, a little bit of a different story. So you might not want
Yep.
to choose that. And so understanding how these different asset classes behave will dictate how we make some
Hmm.
choices. So
I
um,
bet you the a foreign large bill lend has to do with the country choices that they made. I bet you. And that's a far cry from trying to pick a stock that's going to win or lose. Country choice is going to be very different. And I think there could be a lot more information that's useful in terms of country choice. And that could be why you see that difference there.
but there's also not you don't have the analysts. It's
Hmm.
it's just
That
not a
too.
efficient market. You don't have the same amount of focus on the
Yep.
different countries that you have on the US large cap stock market.
Yep. That's a good point too.
Um, so the choice of investment vehicles really do come into play, and we make choices on the vehicles that a lot you don't have access to in the retail market.
Yep.
Um, some you do, and some you don't. So uh, if we go to, for example, this whole arena of large cap, so what we do is we have these different charts of, okay, we're talking about the traditional equity classes. So when we say
Hmm.
traditional, that's usually large cap. Well, I'm sorry, that's usually stocks and bonds, period. Um,
Yes.
and so again, we said large cap is where a lot of people tend to focus. And so the market is very efficient. We look at that asset class. We look at what is it? What are the primary risks that are driving this asset class? in
Right.
terms of the economy and the market and so forth. And then what is the average risk level of this particular asset class? And so we said for
Yep.
large and mid, it's somewhat, moderate. And we know that it's a very efficient market. And so when we go back to that pie chart again, to the next slide, no, to the
Nope.
next slide.
Yep.
Um, we this is the grouping, large and mid, where we'll use ETFs or we'll use individual bonds that we manage along with the investment committee at Wealth Enhancement Group. So there's no fee or embedded expense ratio when we can do that. We'll only
Yep.
do that in IRAs or qualified accounts because there's a lot of tax issues going on there.
A lot of turnover.
But we can do that. We also can do some management of individual stocks in people's taxable accounts, but then there's some additional management around the taxes that we can talk about as well.
Right.
But no matter what, we're going to look for a less expensive choice on what we're doing here. We're not looking at beating the stock market in this arena.
No, it's very hard to, as we showed. So,
When we look, so the back one,
yep, I went too far.
the second half of this traditional equity page is that other area where we start talking about small cap businesses, so the small
Hmm.
businesses in our country, which are much more volatile. They're definitely high risk. They're much more impacted by interest rate and regulation, a lot of other things. And we also look at the international markets, which also have some of their own exposures around regulatory issues and geopolitical risk, and
Yeah.
there's some complexities there. And we're saying in this arena, we don't have the same efficiency that we do have in the large cap. And so when we go back to that pie chart here, we see that we're going to use some other tilts towards value.
Right.
We're going to possibly use some other um, more active types of exposure, but we use funds that people don't have access to in the retail market in this arena. There's a couple of different choices that are
Yep.
that registered investment advisor fiduciaries like us have access to. And so we're using those investments in these arenas. So if you come to us and ask us for a do-it-yourself investment portfolio, we
We can't
can't
get.
give you suggestions for this piece. We can only
No,
give
and
you
there's other
suggestions for the
couple other
large cap.
pieces too, also. But I want to mention that in the small cap arena, it's very highly very volatile small cap stocks. But the volatility is probably only about 70% as much for small cap value than it is for small cap growth. So we lean toward value, and the volatility in small cap is average plus or minus 30% variability of the return each year. In fact, it exceeds, I think, 30%. So
Mhm. When we look at traditional fixed income, it's a little bit of a different story. Fixed income, we've actually read it out. We highlighted that high yield bond
yeah,
thing. We don't like it. We don't use it. If you choose
never
to
have.
use it outside of us, that's your choice. But we think it's much too correlated with U.S. equity. So why bother? It doesn't provide us with the stability that we're looking for, that we could achieve in government bonds, municipal bonds, or even in some instances, corporate bonds.
Or reinsurance bonds, which we'll talk about. But
That's not a
a lot of
traditional
people,
asset.
yep, non-traditional. A lot of people don't even consider high yield bonds to be a separate asset class, and in reality, it really isn't. What it is, it's junk grade corporate bonds rated, I think, triple B and lower. So it's not really a separate asset class per se, and so that means a lot to us because there's a way that mathematically we define what an asset class is, and that high yield bonds don't meet that definition. It doesn't really
Well,
improve
it's a
portfolio
bond, like
efficiency.
just like we don't put municipal bonds in a separate asset class from corporate bond. It's fixed income, and
Right.
just the kind of fixed income that you choose is going to be very, um, you know, important in terms of what are you trying to achieve. In our minds, this asset class, fixed income, traditional fixed income, is all about stability.
Right.
At the end of the day,
Yep.
everything else has gone south. The world is upside down. We know we can go to our fixed income portfolios to access cash. We tend to use individual bonds in this grouping, and
Yep.
we have more control over those bonds as well.
I mentioned having a smart place to get money when in an emergency. This is the smart place to get money in an emergency or a fixed income. And we can sell the individual bonds any day of the week. And it's a way to, get income or get money that you need even in a bad market because these bonds are going to hold up. And that's important. You don't want to sell any growth or equity type of asset in a bad market because you're selling at a fire sale price, quite honestly. So,
And so here again, we don't recommend bond funds. We think that funds
no.
have a whole host of problems with them. We work as the bond fund manager and help you reduce your risk, create more a stable portfolio, and yeah, that's we
Yep.
are talking about that. The non-traditional world. This is the world where there is not efficiencies at all. There's
No. Nope.
also limited access to the types of investments that you can use, especially if
Hmm.
you're a retail client trying to do this on your own. You can see that some of these asset classes, if you go through them, commodities uh, and reinsurance bonds, convertible bonds, even private equity, all highly, highly um, volatile. And hedge funds, too, if you don't know the right kind of hedge funds to use, those can be highly volatile. So this is a risky grouping, and you really need to know what you're doing with these.
And they all add to portfolio efficiency because they all have exposures to different types of risks than the rest of the holdings, the large cap and the small cap and international. For example, the reinsurance bonds in particular, they don't really have market exposure as much as they have exposure to climate events, earthquakes, things of that nature. So it's a very, very different type of risk.
It's listed under the primary risk. You seek reinsurance bonds as a second to bottom, and you look,
Hmm.
it's saying nothing about the market. So um,
Nope.
and that's the whole idea. Idea behind how asset classes move differently is because they are being influenced by different things.
Yeah. By the way, the return on reinsurance bonds have far exceeded the return on high yield bonds too, which is pretty amazing
Mhm.
over the last 5 years annualized. So,
Reinsurance bonds is really how Buffett got his start as well. So
right.
a lot of people don't
Yep.
realize that.
And that's one asset class you can't really gain access to. We buy it through a mutual fund, and that's one of the places where we do use a mutual fund. It's through a firm that only allows investment advisors to use the fund.
Right. Well, we need somebody else to manage that because we could. So
No,
we're
we
more of
can't
the
manage it.
quarterback of the team. We can't play
Yep.
every single position on the team.
Nope.
We have the in deep level of expertise in each piece. So that's why we
Yep.
need that. But so when we talk about that whole non-traditional piece, we actually have this broken up into a couple pieces with the real estate and the alternative equity that we use. We are able to we have funds that could be available to retail advisors. I'm sorry, retail clients,
Yep.
but with a much higher expense ratio and with a
Yep.
much higher also front loads. So we're able to get access. They're called institutionally priced funds. They only an institution can buy them. They have $1 million minimums,
Yep.
but they're much. We would not recommend the choices that we've made in these asset classes to a client to buy it on the retail side. It just would not make
No.
sense for you to do that. It would be
Yep.
very
That's
costly.
correct.
I mean, right there, we've made up for our fee in between the fixed
The, f-
income, no fee there,
the front end
the
load.
reduced fees on these. People don't understand it. They're looking at the fee, you're comparing apples to oranges. And, we have an analysis. I actually don't like to show it because it's a little bit, um, I don't remember whether we kept it in here, Steve, but
It's
it
not in. It's
okay.
not in.
So it
That's
was done
okay.
by Vanguard, and they tried to put an actual percentage amount on it. It's very hard because it's very dependent on each unique circumstance.
Yeah, it's
But
it's guesswork
so,
currently.
we can't really tell you exactly if you're being paid a percentage of your assets, how much of that fee we're making up. But when we have done the analysis, I can tell you that we've more than made up for our fee, even
Hmm.
with the way we're acquiring these different investments for you.
Yep.
Um, the other group, um, which is the group that Steve started talking about with reinsurance bonds, these three asset classes, you can't get access to these three asset classes
No.
using the investments that we've chosen to use. They will not allow a retail client to work with them. They want to
Right.
know because of the risks associated with these asset classes. They want to know that somebody's using it appropriately. If you notice, none of them have more than 5% in this portfolio. We're not saying, oh, go buy 100% of your portfolio private equity, or that would be crazy.
It
But
would.
that
Yep.
right mix is appropriate, and understanding it and working with um, the people that are managing these portfolios. We talk to the people behind these portfolios all the time and can give
Yep.
you a lot of detail on what's going on with them. So
Yep.
again, they're reduced fee, their minimums are waived, and you wouldn't have access to them anyway.
Nope. Yeah, and these particular asset classes are pretty volatile. Natural resources, of course, is very, very volatile. And also convertible bonds can be as well. But again, they enhance portfolio efficiency, and also natural resources, for example, they responds positively when we have bouts of inflation, like it did 3 years ago, and it provided an excellent return for clients in that time period. And it actually went up, I think, in 2022 when everything else went down, went up a
Significantly.
significant amount,
Like,
helping
I mean,
to reduce the variability of performance in your portfolio significantly. So it definitely helps.
and these two asset classes, I do want to say, well, a retail client can get access to this, although I have to question the SEC on why they allow them to get access to this. We would not recommend anybody that's doing this on their own to invest in these two asset classes because of their volatility. Matter of fact, I think when I was working with somebody and I was trying to give them guidance outside of us, and I said, okay, go buy this, they came back to me and they said, oh, like these alarm bells went off on my, I think she was trying to
Hmm,
buy through Schwab or one of the platforms, and they were
hmm.
basically like, warning, warning, do you know what you're buying? Um,
Yes, I know exactly what you're talking about. By the way, we've been using convertible bonds for 30 years, so a lot of experience with them. I initially started investing in 1995, I think it was, and the reason is I read some academic papers which highlighted the return of convertible bonds and how close it was to the stock market in the long run, but with about 70% of the risk, and that's a great trade-off right there. So, which is one of the reasons why we use them.
It's been one of the top performing asset classes for many, many years, not
Many
recently so
years.
much. Um,
And very few advisors use them, which is stunning to me.
yeah,
But
it
hey,
is
I'm happy they don't.
right. But if that's not enough, with us really managing the risk in the portfolio and creating these portfolios that are much more robust, better return for any given level of risk. Um, what about taxes? We recently
Yes.
were talking to somebody that moved their assets to us, and their old advisor asked, "Well, what are they doing for you?" And um, the client said, "Well, they're a little bit more, doing personal finance and doing more
Right.
of a comprehensive plan." And that advisor said, "Well, gee, we could do it also." And like that advisor never ever asked the client
But
for their
never
tax
did it.
return. And
Right.
how could you manage somebody's investments without seeing their tax return and knowing what their tax situation is? We
Well,
think
I
that's
just saw this with someone.
malpractice.
They were at a broker and it's in a taxable account and they're in a relatively low tax bracket, yet they're in a municipal bond fund. It doesn't make any sense. And
No.
by the way, with the new tax code, which was passed this year, there are a lot of opportunities, but a lot of pitfalls in that tax code that you see. You have to carefully manage it if you want to get some of the new deductions that were added to the tax code. And actually, like I said, I'm going to be speaking on that tonight, but that it really requires tax planning, and not just in a single year. You
Every
don't want
year,
to just look at a
every
single
year.
year. You want to look across several years.
Yeah, that's what, and we every year around this time of year, the September timeframe, we start asking for people's tax return if they didn't give it to us in April to make sure
Right,
we do a pro forma. And I do want to remind you, if you have not given us your tax return, you should do that. Um,
right,
Please do that because we can create a pro forma statement to help you make some choices, especially in 2025, as Steve was alluding to. We've always, most of you know that we're very conscious about throwing you into not just a higher marginal bracket, but into a higher IRMA bracket where you're going to be
right.
required to pay higher premiums on IRMA. Now, also, we can prevent you from going into a higher bracket that will prevent you from receiving the additional benefits that the new big beautiful bill is offering, such as
Yep.
the $6,000 opportunity for people over the age of 65. There
Per
is,
person.
yeah. So, having somebody evaluate all that on a regular basis and then helping making decisions in terms of, oh no, that means we better move this particular asset or investment because it's going to kick off this big dividend and we don't want that to throw you into I mean, we can get very, very specific. When you work closely with us, we can work closely with you. If we
That,
don't know what's going on in your life, it's a lot harder for us to do that.
that's correct. Yep.
Um,
Yep. And by the way, these some of the things we do related to taxes. Asset placement is really important. Deciding where an asset should be held, IRA account, tax deferred account versus taxable, depending on the character of the income it generates, also possibly the turnover. Laura mentioned annual pro forma tax analysis, capturing losses where appropriate, because you're creating a deferred tax asset when you do that, that can be carried forward forever. And there's some other things which we probably won't get into now, but they're also
but I
really
do
help
like
from a
these
tax.
stock portfolios. So for a lot of clients that
Oh,
have
yes.
various situations, whether they have capital gains, whether they have high and ordinary income taxes, whatever,
Hmm.
we can use these stock portfolios that
Yep.
provide active tax loss harvesting and even some other opportunities that supercharge those active tax loss harvesting. Here,
Yep.
too, though, I wanted to mention we at the Atlas team don't actively do that. We don't have the bandwidth to sit and manage everybody. Like if we're using stock portfolios on if it's in a qualified account, we don't have to worry so much about what taxes are getting hit. If it's in a
Not at
taxable
all.
account, we need experts that are monitoring it every day and they're harvesting every day and they're making these choices every day. And so we work with the Wealth Enhancement Group, the larger organization that we are now part of, has been able to negotiate with some professional management in this arena at reduce prices. You can't get these prices even if you were a family office or you were going to some of the big name brokerage houses. They don't have the same prices that the Wealth Enhancement Group is now, with its over $100 billion worth of assets, is now able to dictate some of the services that we're able to get. And I think it's important for people to know that we have access to these strategies that are just phenomenal for the right people, not for everybody.
Right. And if you want more information on it, certainly contact us and we'll be able to tell pretty quickly whether it's appropriate for you or not. Um,
But the other little things is, knowing, for example, when you're not going to be really trying to do is active management, whether you can use an ETF, because an ETF is often better than using a mutual fund, even if it's like an index mutual fund. There's tax efficiencies that are there.
right.
Doing some things around optimizing the bond portfolios, around the yield curve, around whether it should be a mutual
And,
fund. I'm sorry, a municipal bond or
yeah. And I want to mention that that's why we want your tax return every year, because if you retire and you go from let's just say a 37% bracket down to a 22% bracket, we may want to make changes in your taxable bond portfolio because municipals may no longer make sense for you. So these are the reasons, one of the reasons why you want your tax return. And another little sneaky little thing a lot of people aren't aware of is that if you have money in a money market fund and you're in a high income tax state like New Jersey or New York or California, you may want to do treasuries instead because they're state income tax free. And you could save several $1,000s a year in state tax if you do that, depending upon how much you have in treasuries. And there's another option here. If you have a concentrated stock position, there's another third party manager we have access to that uses call options to help to try to and generate income on that concentrated position and also help you gradually potentially liquidate it in a more tax-aware fashion as well. So that's another opportunity for the right person.
Right. Well, they'll even do further with colors and puts and all
Yep.
those things.
Yes.
We're feeling more comfortable. We've been using more of the calls, but covered calls,
Not
important.
us, but we're using their
Right, there's
yeah, their
strategies
service.
for some of
Yeah.
our clients. And then there are some clients that are making a significant amount of money and their ordinary income taxes are becoming somewhat onerous. And
Hmm.
there's some tools that we have available for that as well. They're in the private arena, so we're not completely comfortable with introducing that to everybody.
No.
We want to make sure that you understand the exposures, but it is available. And so, I mean, right here you can see again the complexity of how, we're overlaying the tax needs on top of the risk reduction portfolio, and that's why
Right.
every single client has a different situation. We might start out with some
Yep.
vanilla models, but very soon those models get kind of turned around and we now have sprinkles on this model and caramel
Well,
on that model and so forth.
it even reflects, I should say, affects when we rebalance. I mean, sometimes we look at a rebal, that we think is appropriate. We look at the capital gains that may be generated. We might say, well, gee, let's hold off because that could be being a little bit out of the whack in relation to the model could be the lesser of two evils than us generating a tax event that could push you above some of these advantageous thresholds, including the new SALT deduction and others. So we want to be careful.
Right.
And I mentioned at asset location. So, for example, in natural resources, we much prefer to have that in an IRA, whether it be a traditional or a Roth. Same with the alternatives and international bonds, because they generate a lot of recurring income that doesn't qualify for the special 15% rate, or I should say tax rate that's on qualified dividends. That's similar to the rate on capital gains. So it's taxes ordinary income, which can go as high as 37%. So we're really careful with those. Same with real estate. So we try to do this where possible. Individual bonds could be in either because if you have a tax issue, we just buy munis, depending. But this just gives you an example of another thing we look at. And, across the board, we try to help you by making things more tax efficient as well because, there's no risk really to that. That's another one. That is a free lunch in many cases, trying to reduce your lifetime tax burden if we can.
This actually should have
And,
gone earlier, this slide.
yeah,
Truthfully, this
that's
just
okay.
talks about, it just gives you two examples of two investments that we've used. The top one, Cohen and Steers, is for our real estate asset class, and the bottom one is private shares.
Right.
And what we think is so interesting is if you bought that out as a retail client, you would pay these major front loads, which are
Actually, the institutional management fees lower for Cohen Steers. I just noticed that. It's actually about 85 basis points, I think.
oh, okay, all right.
Yeah, that's okay.
So that's the management fee. But just
Yeah.
talking about the front load first, if you put
Yep.
$100,000 into one of these funds, let's say you put it in private shares, you're now starting out with 94,025. It's just not,
Right.
so you have to get out of that hole before you actually start seeing. Then the for the management embedded fee, that's an additional fee embedded in the overall
Annual.
fund. And as you can see, the private shares is significantly less than if you're getting an institutional share versus a
Right.
retail share. And unfortunately, we have a typo here where the Cohen and Steers is actually 85 basis points. So again, that's another, a significant percentage that
Yep. It's about
we're able
20,
to get.
20% less, 25% less in annual fees, roughly. And that's significant. And the private share is even more than that, the percentage. It's roughly about two-thirds, roughly.
And you
Uh,
might ask why that's the case. It's generally that the difference between those two fees are fees that go towards marketing and selling the investments. And because they don't have
yeah,
to market and sell it, because as advisors, we're selecting these particular products, they waive all of that for us. And of
right.
course, they also waive our $1 million minimum because as a whole, we have more than $1 million with them. We don't
Yeah.
necessarily put one client in $1 million of Cohen and Steers or private shares.
No, that's across the whole enterprise. So we qualify for these, obviously, because we have multi-millions in each. So we mentioned rebalancing. It's something we do. We look at it, but we do it in a tax-aware fashion, as I mentioned. Sometimes we run through the rebal. It looks like it's going to generate a lot of tax, a big tax event, long-term capital gain. We may hold off, and if it's late in the year, we may just say, well, why bother doing it this year? Delay the tax bill for a year and a half by doing it in January too. So this isn't a no-brainer, but it is important to do tactical rebalancing because gradually your portfolio will stray from the model and it'll become different from what we originally expected your model to be. It could become riskier or not have enough growth because it moved toward bonds. So it's important to rebalance on a routine basis. And we don't
And you
do it based
say,
on a calendar period. We do it based on thresholds.
right, the tactical word is really, really key here.
Yep.
If you punch on the next slide, it
Yep.
shows how we have these trigger points that will tell us when it's time to rebalance. So it might happen 20 times a year, it might happen 0 times a year, but it's one of those things where we get alerts on when we hit these triggers. And
Mm-hmm.
that's very, very different than what a lot of firms do. They'll rebalance, if they do rebalance, they'll rebalance on an annual basis.
Right.
They'll just rebalance arbitrarily, like a specific calendar designation, as opposed to when needed. And that to us is a problem because you're really not taking advantage of the whole concept of buy low, sell high. I mean, who knows on that one specific day of the year what what your portfolio is going to look like at that one day. It needs to be done on a continuous basis when needed. But also with some thought, as Steve mentioned, not just doing it arbitrarily, but okay,
No.
the system is telling me to rebalance. Does this make sense for this client?
Right. That's right. It's always done that way. By the way, that's another advantage of having individual bonds because in many cases you may have a bond coming due, within a year or a couple of years, and that's actually an opportunity to rebalance, but one that doesn't create any tax event. So that's a really great aspect about using individual bonds as opposed to a bond mutual fund too.
Right. Really important here that we've had so many people come to us at the point of retirement and say, okay, I saved really good. How do I take the money out of here?
Right.
And so, figuring that out is really important.
Yep. And where to take it from, how to do it in the most tax efficient way, maybe even the timing. If you need a lot of money out of your IRA, for example, you may make sense to split it over 2 years. In other words, do it on December 20th and do it in your next piece on January 5th, argument's sake. There's a lot of aspects to this. And I'll be honest with you, sometimes it may make sense to use a HELOC instead temporarily. If you're going to lose some big tax benefit by pulling it out of your IRA, especially as I think as interest rates decline, most likely the rates on HELOCs may go down. It may make sense to temporarily use a HELOC and spread out the withdrawals from your IRA if you can. So there's a lot of opportunities to properly turn your portfolio into a paycheck, but also do it in a tax efficient way too.
There's the addition of doing Roth conversions where you
Hmm.
might pull some money from taxes from the future to the current period of time to smooth out the overall tax liability when you
Yep.
do RMDs, whether you want to execute something called a qualified charitable deduction, which can definitely benefit those people that are charitably inclined. Um, but one of the biggest bullets that I'm looking at when I look at this chart, Steve, is right there in the middle is the sequence risk. And that's a whole nother
Right.
conversation for another day. But the idea of how do you structure the portfolio, managing risk, and taking money out properly so that you're not taking money out when the portfolio is going down. That is
That's right.
absolutely the worst thing to do. And so,
Or if you
it's
are,
really
that you're
key.
taking it from the smartest place.
Hmm. So there are a lot of things that a portfolio manager should be doing for you. We are doing as much as we can, as far as we know. Um, and of course, there's the last three ideas here, which but, we're not going to get too into right now. But the whole idea of monitoring performance, understanding what's going on in the economy, making sure that we revisit all of this structure again in terms of how are you feeling about your portfolio? Are you comfortable with it?
Right.
What are your needs today? What else is going on that we should be aware of? All of that, going back to that whole key is really, really important. So that's what professional investment management is all in general. And
Yes.
those of you that we have reached out and you've said, oh, I'll meet you next in 6 months or whatever, it's best when we know what's going on with your life so that we can make sure that we're partnering with you and we're doing the right things. Because the bad news of all of this is that things are always changing, whether it's
That's what I mentioned. If you don't
whether,
even want to meet in person, we always have access to technology. So,
absolutely
and it
Zoom,
can be done very efficiently that way. So
right?
if you don't want to drive to our offices or, you're really busy with other things, we know most of us are, we can do it in a very efficient way too. So,
Right. But this your changing needs, the changing economy, the changing tax code, the changing
right.
regulations, all of that need to be factored in and talked about. And it's great when we get together because we try to really think about when we see something has changed. Okay, this is going to affect this client and that client. It's always good for us to talk about things because you might bring up something in the conversation that um, triggers more than what we initially thought about.
Yep.
So thank you for listening to us. And again, keep in contact and hopefully you're enjoying these conversations. And we'd love to make sure that we are talking about the things that are relevant to you. So if you have any ideas or things you want us to talk about, please let us know. Thank you and take care.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.